Muito boa tarde, muito obrigado ao CIDEEFF e à professora Nazaré da Costa Cabral pelo convite para estar aqui presente. Eu vou respeitar a linguagem tácita de trabalho nesta conferência, houve aqui uma colusão entre os palestrantes para fazer a linguagem em inglês, de modo que eu vou, com a vossa permissão, passar para inglês. Nós estamos, we are really living through history being made, and it's interesting to see how the consensus about the explanation of the recent crisis we've seen is evolving and converging to a consensus view. My presentation today, I'll do a very short wrap-up of the history of central banking. I'll talk about the political contradictions of the EMU, and then I'll focus on the monetary policy and financial stability mandates of the ECB and also of banking supervision. The typical monetary policy goals are threefold: price stability, economic growth and employment growth, and financial stability. The primary mandate of the ECB is, of course, price stability, but you could argue the other two are there as secondary mandates. And the financial stability mandate has been pushed towards a level, at least in terms of perception, that is comparable to the price stability mandate in my view. And it's the one used to justify the intervention of the ECB also in my view. But let's go back to central banking and remember its origins. Really, the first central bank in Sweden was really a public institution to loan out money to government. And the Bank of England was created to buy government debt. We had mostly private central banks, and they grew to become the bankers' bank, you know, the banks of private banks, where private banks deposited money and conducted settlement operations. Then we had in late 19th century, basically, the figure of the lender of last resort to banks, a bit coming out of the free banking in the United States, but also of England, and the words of William Bagehot are here important. In times of crisis, the central bank, contrary to the practice of the Bank of England, must be willing to lend freely against solvent banks with big haircuts. It means high interest rates, and against good collateral. And so we had this in the Bank of England, and a bit later on also in consequence of several banking crises, the Federal Reserve Act of 1913, and the US being what it is, it really begins the modern central banking there. So monetary policy, as we understand it, comes later. It comes really mostly in the US with money supply and then forex or gold interventions, let's say, characterize it to manage aggregate demand. We had a few important characteristics of the early monetary policy. First of all, we had really outright transactions. So this started as an accident. The Federal Reserve didn't have enough interest income, and so it started buying government debt. And so this is the origins of open market operations by accident. And initially, central banks only purchased public debt. So the role of central banks was really to manage the portfolio of government liabilities, either debt or money, which is a government liability. And the central banks were seen as lenders of last resort to banks. So the concept of financial repression that Reinert and Sabrancia talk about was key, for instance, to ensure that the debt weight of the United States and England post-World War II could be brought down to much reduced levels. You also had one thing, which was high reserve requirements as a key feature of bank regulation and of, let's say, the compromise between public and private money. How much private money can be created with a given amount of public money? Over time, this central banking changed, and there were reasons at each point to change monetary policy and monetary policy instruments and procedures. You introduce temporary transactions with collateral rules. But when you do that, really, the central bank becomes a creditor to the bank. I mean, outside times of panic, of course. So you introduce a conflict of interest between the central bank and the banks that are counterparties. You introduce also a super senior status to the central bank, which is, you take the central bank outside bankruptcy courts and bankruptcy laws. And you actually make it easier to create private money. So reserves can be obtained by private banks basically through regular temporary transactions without the stigma that is attached to the discount window. This was accompanied in most developed economies by the lowering of reserve requirements, which means a greater predominance of private versus public money issuance. And as a consequence, public money or money supply became even more endogenous than it already was. You also came up with the figure or with the concept of independent central banking from the 80s onwards. And so basically the key point of this independent central bank is to limit, let's say, the government ability to do financial repression. The case of the Fed and the Bank of England are different because of, especially Bank of England, because of its mandate. And you tend to focus away from reserve requirements and towards capital requirements with a feature that was introduced by the Basel agreements, which is risk-weighted, risk-adjusted assets. So here I'm plotting the monetary base against M1 money stock, and you see the effect of the quantitative easing in the US. And here you look at the money, the M2 aggregate, basically bank deposits, demand deposits, and interest deposits, and compared with the monetary base. Basically, the idea of comparing private money with public money. Now, moving away from this history of central banking and towards the EMU and what are the problems that the ECB is dealing with, really, in my view, the EMU and ECB, it's all about dealing with the political impossibilities built in the EMU. Fritz Preussel talked about basically the euro being thought for a group of core countries and the peripheral countries coming in as a political imposition. So this was not, it didn't make economic sense. It was not an optimal currency area. But we're in it already. So the peripheral countries are there. And so we're trying to do, let's say, a political impossibility. We're trying to have a monetary union which does not have fiscal transfers between member countries, where the role of central bank has got to abide by certain rules which were set from the beginning. You don't do financial repression to guarantee sovereign debt sustainability. The ECB is not a lender of last resort for sovereigns. Because of the design of the monetary policy instruments, the ECB is a lender of first resort to banks, but actually not a lender of last resort, as we saw in numerous instances in Greece and Portugal and Cyprus. But the ECB, in my view, through interest rate setting and QE, has been the EMU savior of last resort. I mean, I think we are on the final stage of the EU, where really this is a massive, it's the biggest EU program, economic program, and it's made a difference. Of course, there are other political impossibilities which I don't have time to address. And these are not just German determined political impossibilities. These are also widely held view, even among economists. So, in my view, given these political impossibilities, the only way for the euro to work, for the EMU to work, is for each and every country in the eurozone to run recurrently either balanced or in surplus current account balances. That means, and it's actually, if you look at the austerity policy imposed in the eurozone, it's actually what has happened. Most countries in 2016, I'm not sure, I haven't looked at the data for France, but most countries were forecasted to run current account balances in surplus. So the euro area is running a huge surplus, and so we've built a German euro area that, rather than a euro area that is Germany, to paraphrase a famous speech by Thomas Mann in 1953. So this trend is unsustainable. It leads to the threat of trade wars, and so Navarro's advisor to Trump administration is understandable, and you should expect more. This didn't used to happen in Germany. You see Germany's surplus, and you see a line coming from 2000 onwards growing. And the reason it didn't happen is when the surpluses got too big, Germany got pressured, namely by the United States, to correct those imbalances. So given these settings of the EMU, what happens to the ECB? So the ECB faced huge ex-ante and ex-post difficulty in ensuring this irreversible currency union. The euro is irreversible. Because the euro area does not have meaningful fiscal transfers and because debt monetization is prohibited. So not only that, you had this problem in the beginning, but now you have legacy problems because you've got huge nominal and real differences between countries, namely with peripheral countries. You've got huge differences in interest rates, and you've got very different international investment positions of member countries in the euro area. This means that monetary policy, this question of financial fragmentation and the lack of transmission of monetary policy can also be equated to really monetary policy as huge fiscal effects in the eurozone. And the solution to this irreversible currency union is really to adopt the second best solution, which is you build the euro architecture so that you equate a country belonging to the currency to every single bank belonging to the currency. And to do that, you've got this target 2 system, which is nearly always ready to convert deposits into public euros, deposits and other liabilities. The banks, not the countries, are irreversibly linked to the euro. Another issue with the instruments of the ECB is that private debt was accepted as collateral from the start, different from what happened in other central banks. Because central banks was all about managing public liabilities, not about buying private debt, which has fiscal effects. And so you had these problems with private debt, and there's a very interesting article by Anne Siebert, Love Letters from Iceland, how the Icelandic banks took advantage of the system to get money. They basically wrote letters to one another and got those letters to be exchanged for euros by the Central Bank of Luxembourg. And so Central Bank of Luxembourg, the euro system lost money there, basically. And the ECB owned soccer passes for the most famous European soccer stars. I'm not saying, I'm only going to say that one of them was from Madeira, but I guess that should be... Okay, so you had very large effects, and you lowered reserve requirements in Portugal. They fell from 17% to 2% and then to 1%. So you basically have a large degree of private money creation to public-based money. So you start the crisis and you look at the ECB financial stability mandate. You had the financial crisis, and as the previous speakers told, it basically revealed the euro crisis imbalances that were already there. And so the ECB does whatever it takes to save the euro. It basically allows large target imbalances, which really are automatic given the architecture of the euro. It lowers interest rates. It helps banks, among others, with the securities market program. And more recently, it has embarked on this huge KEU program, which will grow to 2.3 trillion, and in addition to 500 billion of long-term loans to banks. This is, monetary policy, or at least it can be comprehended within the financial stability mandate of the ECB, or could be argued that. But in addition to that, as was already told by other speakers, the ECB assumes a policymaker role. So you have a mission creep away from the treaties. There's no place where it says that the ECB can be a member of the Troika. And what happens here is that the ECB uses its monetary policy powers as carrot and stick to act in support of the European Council, Eurogroup, and the European Commission, and you see several instances where that happened. As this graph was shown already, so you see huge imbalances in the target system. The target system is, supporting the inherent contradictions of the euro architecture. You have the ECB as savior of last resort, making assets its balance sheet growth, and in the red line you see the QE program, but you also see in the blue line mostly the effect of the long-term loan programs. And you see here one effect, which is a correlation really, but it's basically showing euro area real GDP, which peaked at in 2008, and only in 2015 did GDP reach that level, supported by the divergence that was shown by Fritz Preussel. You can think that basically the aim of QE is really the third implicit mandate, which is not explicit in the treaties, which is to support economic growth and employment growth. So maybe they have assumed an implicit mandate which is not in the treaties. But contrary to some of the other speakers, I believe that the ECB policy has been key to countries like Portugal because it has had large fiscal effects. And it is these large fiscal effects that have allowed the country not to avoid bankruptcy, really. And so what you see here is the new German Portugal. Portugal, the last time before 2012 that Portugal had trade surpluses was in 41-43, where its Wolfram exports, because of the arms embargo to Nazi Germany, Wolfram price shot up, and so you had trade surpluses under Salazar in 41-43. And basically since 2012, Portugal has had balance or in surplus trade balances, which are just about sufficient to support the trade income balance deficit. And you can see that the trade income balance deficit, although external debt has grown or is basically a bit more or less stable, it's fallen. And this is due to the policy of reduction of interest rates. So you have very marked effects of monetary policy because countries have so different internal investment positions have really fiscal effects here. And you see also Draghi's July 2012 effects, basically the yields on the 10-year yields falling since. And now moving from the monetary policy and financial stability mandate to the banking union, my question is whether power begets more power, in the sense that the ECB wanted to become the single supervisory mechanism, which is, contrary to what is said, it's not just supervision, but it's also definition of capital requirements, and it's also the pre-triggering of bank resolution. So these are huge powers. It's not just banking supervision. The supervision process today is complex and unyieldy. Each governing council meeting for non-monetary policy issues basically has to make 100 decisions on average on does not object, basically. So rubber stamping, huge number of decisions on banking supervisions. And you have other problems. The process lacks certainty, so you don't have rules on when can bank resolution be triggered, and you've got huge conflict of interests because the central bank is the major creditor of the bank. So I don't think it will stand the test of time. And so how do you understand the new supervisory powers of the ECB? In my view, it's a bit to imitate what happened in the US. The Dodd-Frank Act gave this power to the Federal Reserve. It's also based on the, in my view, incorrect idea that it was necessary to break the so-called bank sovereign nexus. And it's also, in my view, and this is most important, a misguided attempt to address an unresolved issue in the euro architecture. So this issue that currencies, it's an irreversible currency union of banks, not of member countries. And so the response by the ECB is really to get greater direct control over banks, a bit of power centralization. And so, in my view, the implicit objective of the ECB is really to address the target 2 imbalances, which were first identified by Hans Werner Sinn. You get control of the euro area largest banks with 211% of GDP assets. You get a firmer grip on banks with higher target 2 dependence, firmer grip on banks of countries with high target 2 dependence, which means that the ECB is unsatisfied with the traditional regulatory tools. But it also means that from the standpoint of the ECB as a creditor, they minimize their risk, they minimize their exposure through this supervisory control, but also through the ad hoc increases in capital requirements and through the permanent threat of pushing a bank to resolution. So what you see now in the banking universe, you see starkly varying leverage ratios for banks. You've got to see contraction of credit for of bank credit in some member countries like Portugal. And you see also, in my view, more favorable treatment of big transnational banks vis-à-vis smaller banks. So this is a plot of the varying leverage ratios, which is an indicator that is not risk-weighted. Assets are not risk-weighted, and you see huge divergence of leverage ratios. The leverage ratios of banks in Portugal are twice as large as the average leverage ratios of banks in Germany. So you've got a huge difference being imposed by regulators on banking business across countries. So, in my view, the way the ECB has been using its supervisory role is actually contrary to what it's trying to do on the monetary policy front. And so it's creating instability on the currency union because it's trying to address a problem that is not really addressable. And there's also more mission creep in addition to belonging to the Troika. There's a view on industrial policy, on winner picking, towards transnational large banks, view that industry, which was conveyed by Draghi, is unprofitable and must consolidate. So these are views that should not really be expressed by the central bank, in my view. So what should we do? I think the ECB has played really a key role in the survival of the euro this far. There are significant fiscal effects to monetary policy. There are some proposals coming from Germany, in my view, that not only from Germany. The Jacques Delors Foundation has put a report where they suggest the ECB should reduce its role and pass it on to the European Stability Mechanism, but really the solution is too small because it does not have the firepower of the European Central Bank. The KU has a large effect, maybe 6 to 7% of GDP for crisis countries, depending how long the program lasts. It's enough to gain some time, but it's not enough to address the structural problems, the architectural failures of the euro. So I think you should consider changes to the monetary policy instruments and procedures to try to reduce the fiscal effects that there is and the conflicts of interest of the central bank with the banking system. And you could think of some measures which I point out. And I do think that the central bank should be out of banking supervision. I think this SSM should be spun off from the central bank. I think the SSM, I don't evaluate positively the form which the SSM has done supervision, very interventive, very trying to act under perspective of the stakeholder it is, the central bank. In conclusion, I know it's already lunchtime. I would start by this quote from Otto von Bismarck: "Politics is the art of the possible, the attainable, the art of the next best." And I would argue that ECB faces a nearly impossible task of trying to maintain a single currency, which politics and policy rules have nearly made impossible to maintain. So we face this conundrum, which is politics should not be the art of impossible, whereas monetary policy should not be the next best solution around these political impossibilities, but it's really the state of affairs in the Eurozone. The ECB monetary policy and financial stability mandate have been key to temporarily saving the euro, but I think the SSM has been counterproductive to that first goal. And the ECB and the euro area face significant challenges ahead. And I think they are only resolved, as was here referred before, if we address and recognize these political impossibilities, and if we want to go on with them and try to get those fiscal effects out of monetary policy. Thank you very much for your attention.